Welcome to the Broken Pie Chart Podcast, episode 274. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, we had a new all-time high, and then we didn't have an all-time high.
Right. We hit it earlier in the week, and then a little retracement there, a little gap closing, and then not bad. Closed out the week okay, but kind of sideways for the week, really.
Yeah, I mean, this is all right. So let's start here. This is from Charlie Bolello on Twitter or X, whatever you want to refer to it as. Showing over the last, since 1990, the S&P 500 annual total returns. And he's got this chart, and you have this big blue line that's the average total return. And then you look at where we are right now in the markets, and then you have a lot of squiggly lines concentrated around the average, but then you have these sort of outliers. We're above the average so far, Jay. And I think at one point, will we have 12% year to date at that new high? I'd have to think about that. But I mean, I don't know. What do you think? I mean, is this
so you're referencing basically it's a line chart of every year of the S&P overlapping, right? With here's the average drawn in there, and guess what? The average is up, right? So this is from 90 to 2024. So 34 years looks like right around 10%. Okay, that's information we all know already, but the reference here about how this year is doing against the average, right? This is I don't know, top quartile year. There's plenty of years that have been better than where we are at this stage into the end of May. But it's better than average. It's definitely better than average. Like the worst, besides the first week, it looks like, was average, right? So it's been a strong year so far, no doubt about it.
I didn't plan it this way, and I love to talk about 94, 95. Do you know the best year on here, Jay?
Well, I do because I'm looking at the chart. You're right. It's 95 is the best year on here, and you have definitely been saying, look, this could feel a little bit like that 94, 95 year because it's set up that way, right? Coming off of higher inflation, Fed's cutting rates, but the rates still stayed high. All those characteristics of the 94, 95 run, you have said there's some similarities to what we're going through right now.
If this turns out to be the case, I will take full credit for it. If it doesn't, I will absolve myself of any reference. I'll deny I've never ever made a reference to 94.
You probably would have to erase at least 30 podcasts. Go
back and listen to the old episodes. But it's sort of, I didn't plan it that way. And by the way, 2008 is the worst year of all of them, of course.
I remember that year.
Yeah, me too.
It wasn't that long ago. I wonder if that second worst year was 2022. It might be. The second or third worst year on this chart is 2022. Because after those two, then the worst year is a -10, and we know 22 was worse than that. So, yeah, look, we had a bad one, in 22. No one's forgotten 22. Certainly, people like to talk about 2022 quite a bit to us, but so it's not surprise. Listen, I hope you're right. I'd give you all the credit in the world. I'd love to give you that credit.
So by my count, over the last 34 years, right? Because it's 90 to 23, which means there's 34 years. You can't subtract one from the other. So if I count 6 down years, so this is saying 17% of the time the market was down. Of course, not down as much as 2008 every year, but
well, we've said that's right in the number. This is all historically normal, and you could go back even farther. Go back to 1950, which is when you and I look at things. Generally, we go back to 1950 data. It's all consistent. The average, I think, is a little higher this past 34 than say the past 84. No, 74. Sorry, but it's the down years. Being in that 20% range, that's kind of normal. That's usual.
Yeah. It's All right, we'll see what happens. I mean, this is why we buy and we hedge. I mean, I don't know if it's going to be like 1985. I mean, I'd like it to be. We want people to get the benefits of being invested. Why not?
So I know it wasn't on your plan to talk about it, but we did have one nasty day last week on Thursday where it just seemed like it was after the Nvidia earnings. I know we're going to talk about Nvidia in a bit, but market gapped up and proceeded to immediately sell off, and it turned out to be, I don't know, down one and a half at one point, right? So when I was on the road when this was happening, I was I think I was at speaking at a conference. And I said, what happened to the market, guys? And you were nice not to say more sellers than buyers. Good job not saying that. Which,
yes,
I love when you say that. But it was an interest. It was a rate discussion, right? And I just looked at the probabilities. We've been talking about September as potentially the time for the first cut. The probabilities now have the most likely first cut in November, not September. So 50% chance rates stay where they are. Now, just over 50% chance rates stay where they are at the September meeting. Only a 45% chance they get cut. So that has shifted, right? As that probability of a cut gets later on in the cycle, I think that can cause. By the way, who's surprised about that revelation, right? But I know the market's going to react to.
Well, I agree. I think we even messaged about this. Really? Who cares if it's one or two cuts? Who cares?
And look, and now all the cuts are pushed out to 25. I hope we keep talking about that. The cuts are coming, so the market's up. I love that dynamic if this kind of stacks and extends for a while, right? Take the appreciation in the market, plus 12% right now, like you said, and at the high. And it's done based off the, projection of both rate cuts, and the market getting cheaper because earnings are going up. And I know we're not talking about that too much yet, but just great. Let that story go on for a while. That sounds great to me because it can go on for a while the way this is all positioned. I know you want to talk about Nvidia.
Well, I'll just ask you a question about that. What would they talk about on CNBC all day if the Fed just came out and cut rates and we're
like, okay, we're done. About earnings, right? We could talk about corporate earnings going up. I mean, we could talk about, what's happening in, I don't know, AI, which is everybody's talking about as well. So I think we probably just did it too, right? So I don't know. We've been leading up to talk about Nvidia for a while. Let's hit on it real quick because it just had its earnings. And again, I was on the road. Of course, I was watching. I was sitting in a restaurant watching the chart after hours on Nvidia.
Yeah, I mean, all right. So Nvidia, they had a strong earnings report. I listened to some of the call, and I know I'm the guy who reads PDFs. Yeah, I listened to a little bit of the call, and I think the guy is his name Jensen, who was I think leading some of the Q&A or the discussion.
Yeah, the CEO.
Yeah, so there was an analyst and
in the Thriller jacket.
Is that what?
So a lot of zippers, Jensen, on that jacket.
Right, he's got zippers. So one of the analysts, I forget who it was, not like I know all the analysts on Nvidia, asked something about the Blackwell GPU or chip, which is I think that's their latest next generation. And I think the question was are you in production right now? Or are you going to be shipping those? And I forget the question. It was when will we see revenue, in 2024? And I hope I'm not misquoting, but I feel like Jensen was like, yeah, no, we're going to see a lot of revenue from that.
A lot of revenue.
Yeah. It was a funny little thing, and I didn't listen to too much, but I was watching the screen in after hours. And as he was saying that, I saw another little blip up, as, they like that. They like that, whatever that was. So yeah, it was a really good report, I think. I mean, if you look at over the last 10 years, their growth of their stock is up 23%, but their net income is up almost 8,000% over the last 10 years. their revenue is up like 1,700%. They must have been doing a lot of R&D and spend early on. And I think, quarter over quarter, their revenue was up like 18%. So they're still growing. And let me just stop there. I mean, I know you were traveling and you didn't get the play-by-play like we sort of did, but this is what we were waiting for. We're like, okay, if Nvidia can still keep it together, guys, still please the street. I think they pleased the street.
They pleased the street. They absolutely did, right? So that was the thing. We thought if Nvidia would kind of like put the kibosh on the AI story, then maybe that would be a catalyst for the market slowing down. You didn't get that. You got a beat and you got upside move. I do think we didn't talk about the 10-for-1 split.
Talk about that. Yeah.
Yeah. So, so for those of you that don't know what a split is, right? So essentially, they will lower their price, but increase your share count, right? So I think it's a 10-for-1. So if Nvidia is trading at 1,000 and you had, 50 shares, after it goes through that 10-for-1 split, you'll now have 500 shares, but Nvidia will be trading at 100. So it's no change in value. It just ends up lowering down the stock price, increases the outstanding share count. A lot of folks think that, it doesn't add value, but it's certainly, it's nice. It's a momentum thing. It helps the average investor buy more shares. As option traders, it makes it easier for us to buy even lots, because with Nvidia right now trading at 1065, if you want to buy 100 shares to sell a call, you need to put up $106,000 to run that strategy, if that's what you're going to do. Now, you'll make the same amount. It doesn't change the percentages, but maybe you don't want to put up 100K. Maybe that's too big of a position for you, right? So now, when they split for an options guy, we like this, right? They split the stock, and then it makes it easier to do, option strategies around it. You don't have too much notional exposure, right? It makes it easier for you to manage your risk. I think they do it because they want to give access to more average investors who don't want to spend $1,000 per share.
Well, sure. And if you're just buying, let's say you had a $10,000 account and you're like, oh yeah, I'd love to allocate 10,000 or 10%. Okay, that's a share. So, but when you get into options, like I run a few hedged strategies, and we've got to size in the positions to the portfolio. But one unit is equal to 100 shares, because on 100 shares, one contract is maybe hedging that. So to your point, like if you have an account that's all of a sudden has Nvidia, it gobbles up a lot of that space. Or it's tough to really, I can do one lot or 10 units, but I can't do 12. It sort of starts to, but it's materially, it doesn't matter. But optically, I think it helps. And there are people who might not be able to buy the stock, or some people who might think that a split is the precursor to another run up. I think it gets a little momentum on this, a little flow, don't you think?
It happens. But, look, Apple's done it a bunch of times. Tesla's done it a bunch of times. I think we could rattle off a bunch of them. And it can be a little bit of, buy the rumor, sell the news kind of a thing. Maybe that's not it. But just maybe buy the anticipation, sell the event. You never know, right? If you're running up because of a stock split, if that's it, then that's probably something that then gives back. The market will give back those gains, because there's no change in value there, except, maybe you get a little extra lift from short-term demand. But I think it's, I'm sure someone's done the study of, the run-up before a split and then performance post-split. I'm sure there's something like floating around out there, Derek, for you to find with all of your wonderful sleuthing skills as finding market information.
That. Yeah. Does that help from a stock-based compensation standpoint, or maybe they can do fractional units? I don't know.
Oh, like for employees? I remember that is one of the look. Some firms do that. Google has that, right? The reason there's 2 shares of Google class is because they wanted to make sure their employees, Alphabet, their employees, could participate, right, with the different pieces. It could be that. It could be, options. You never know, right? I don't know if they allocate like restricted stock units internally. I don't know anything about the Nvidia comp plan.
All right, let me move off that then and talk about market cap. So market cap is simply the number of shares times the price, and this is a good, the stock split's a good one to talk about. Imagine if you had 1 million shares outstanding and your stock price is $1,000. Well, that's, what is that? $1 billion, right? In market cap then? 1,000 times a million?
1,000 times a million is $1 billion.
Yeah, there you go. But now if it's a 10 for 1, you have 10 million shares, but now priced at 100. What's your market cap?
Same.
It's the same. That's right. But speaking of market cap, over the last 12 months, Nvidia has increased their market cap by 238.2%. Apple has only increased their market cap by 8.9%. So, and this is it. It's getting close, Jay. 2.865 trillion is Apple's market cap. Microsoft is still number 1 at 3.173 trillion. Jay, we got Nvidia coming up 2.553 trillion. Like they might catch Apple. I don't know, but it's within reach.
Yeah. Well, I mean, it seems to be. I mean, you're right. It's close. It's is that just over 10% difference in market cap there? Can Nvidia outperform Apple by 10%? Sure. That's not to mention Apple's doing a lot of stock buyback, right? Does that impact the market cap, Derek, as they're buying back stock?
Yes.
So less shares outstanding.
Yes.
Yeah.
In theory, the remaining shares have more value, but that's a fundamental discussion.
That's a market dynamic that has to kick in, right?
Isn't this a great example, though, of why you just buy an index? Like, let the index figure out who the biggest company is, and you'll own more of those as they're growing.
When I look at the market cap, there's a handful of other surprises on here that I bet people don't know have really large market caps.
Well, and I should throw the caveat out there. This is not the S&P. This is just
every stock, right?
Yeah, probably that trades in the U.S., but it's although I don't see Alibaba on here. But Jay, which one sort of perked your interest here?
I was Broadcom being number 10.
Oh, I had another one. Okay, Broadcom, number 10.
I didn't know they were in the top 10, but number 11 is JP Morgan Chase. So Broadcom bigger than the biggest bank in the world.
And Tesla. And bigger than Tesla now. Tesla's coming down.
Tesla's out of the top 10, right. Tesla's out. Tesla's number 12.
The one for me was, and I shouldn't be surprised because we're talking about Nvidia. They sort of make Nvidia stuff. Many people don't realize that Nvidia doesn't make their own stuff. I mean, they developed their own chips and GPUs, but Taiwan Semi, Jay, 8th, 814 billion. Yeah.
Yeah. Yep.
So, yeah, I mean that's it. Walmart's 14. All right, I won't bore the listeners with a discussion about buybacks and revenues. Well, Walmart's an interesting one if you want to do a deep analysis on the growth in revenues, growth in net income, and the growth or decrease in the share count. Like I think Walmart for a couple of years, their revenues weren't necessarily growing, but their value was going up and they reduced a lot of shares. So no surprise though. All right, so we'll watch that. That's why you buy an index. Just let the index kind of do its thing. Jay, the other thing I'll mention is, well, speaking of mentions, AI being mentioned on earnings calls. Let's see. It's up 186% since Q1 of 2023. And mentions of AI, 100 max. Okay, so whatever this graph is, it's a confusing graph. Like earnings calls are mentioning AI. companies are using AI. So
and it seems like almost every company is mentioning it. If 100's the max, this chart looks like it's like 95.
I'd love to see a comparable chart to blockchain. Remember when people are telling us that blockchain was important?
Yeah.
I'm being sarcastic because
you love the blockchain.
I don't think it's very valuable, but
all right.
I don't know. Does this mean that more CAPEX is coming for?
Well, I mean, so why does the market like AI? By the way, I think I heard Elon Musk today said AI will replace everybody's job. Just everybody.
All right. So that's productivity gains.
It's productivity. That's exactly right. So what does that mean? It means better margins. We've spent a lot of times talking about margins on this call before, right? So it just, helps companies produce more with less, right? Which goes to corporate profits, which is why, one of the reasons we think the market can move up is increasing corporate profits. So that's kind of the connection there, why it matters so much. If everybody loses their job, though, customer spending. Sorry, I'm still stammering. I'm still getting over it. It was a rough red-eye flight back there.
Yeah, those are tough.
Anyway. Right. So if everybody loses their job, nobody's spending the money, right? But who knows? Maybe AI figures out that we could become utopia. You don't know.
I think you just gave me a license to discuss the pros and cons of universal basic income on a future episode. That would be one when you're out, Jay.
You should wait till I'm out for that one. Yeah.
Yep.
Yeah.
All right. So AI is being mentioned. Yeah. I mean, I think you went to productivity. I went to CAPEX. I mean, look, we don't try and pick and time markets. That's why we buy and hedge. If you want more information about that, shoot me an email, derek.moore@zegafinancial.com. That's Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly. And send us listener questions too. I don't think we have one this week. We got some comments, but we don't have any questions this week. So, all right. So here's maybe a contrarian or indicator. I don't necessarily know if this is anything. FMS percent investors thinking recession is likely. I don't know really what FMS is.
Unlikely. This is
unlikely.
Recession unlikely. So the fund manager survey.
All right, who are these fund? I looked it up. I Googled it, and of course, everything on the internet's correct. It says
it's Bank of America's Global Fund Manager Survey.
This is financial management systems users to manage income, expenses, and assets. That doesn't sound like what it is. Anyway, it's a cool chart, and we're going to talk about it. So, yeah. Right now, I would say that just under 80% of FMS investors say a recession is unlikely compared to November of 22, when probably only around 10% said it was unlikely, meaning 90% said it was likely. So I bring this up because, literally a little bit after the lows of the markets in 2022, they were saying it was very likely we'll have a recession. Now, not so much. And I think just because it's higher, from 2012 through 2018, it was higher than this. And by the way, we had no recession. So I don't know, sentiment's changing.
Yeah, usually you see a chart like this, and you think, everybody got it exactly wrong, right? But I do think that we've talked about how everybody thought recession was coming the end of 22, that 23 was going to be the year of the recession, right? We talked about this many times. 26 out of 27 analysts called for a recession. We didn't get it. But when you look at, the other times where this number, the unlikely number was low. That's weird to say. So let's just say the likely number was high. It was April of 2020. I think we all thought accurately there was going to be a recession from the pandemic. That happened. March of 09. And
Mark Haynes' bottom.
Now that was the bottom. On both of these, those were bottoms, and so the sentiment was late. But look, sometimes the market's already. So Derek, the timing on when you find out you're in a recession is usually after it's over, right? Like, oh yes, we were in a recession 3 quarters ago, right? That's usually how this number comes out, right? When you find it out. So I think the bottoms look to have been called pretty well, right? The Marcane's bottom of 2009. I mean, there's been other bottoms between now and April of 2020, but
no, the major ones. I think you're right. It's like the major ones.
There really was one, right? They were just, the survey is a little late. People digesting it, and it's weird. This isn't like mom and pop in the grocery store. This is a fund manager survey.
Yeah, or maybe whoever these people are.
Well, I mean. Right. You'd think there's some people that would just at least understand financial information, right? So,
yes.
Yeah, so it feels more like a sentiment. And so now where we are on this, so great, fast forward.
I don't think it's helpful, though, that where we are right now. I think the way you've looked at this is maybe the way to think about it as a contrarian is to say, when this gets to very, very low levels, meaning a recession is unlikely, meaning only a tiny bit of people say, like 2% of the people asked said a recession was unlikely. Like the recession was not going to happen in March of 2009. I think when you see spikes like this, like, okay, this is a pretty good contrarian indicator. I don't think it's useful for any other time. The fact that we're at the higher end now, it's irrelevant.
Yeah, right now it's 80% of people say it's unlikely.
Yeah, and guess
78% of people say it's unlikely we're going to get a recession in the next 12 months.
And what did we learn last week? Was it 90% of the time we're not in a recession or in stagflation? So, all right, let's move on from this, Jay.
Okay.
We're done. We're done with this.
All right.
University of Michigan inflation expectations during the next 5 to 10 years. So they survey people, and I'd love to be on these survey calls, by the way. It would be funny. But they survey people, and they say, what do you think inflation is going to be over the next 5 to 10 years? Maybe they ask them for a number. It hit 2%. It hasn't been as high as 2% since, there's that 1990 to 1994 period again, Joe.
There it is, but not 95. Yeah, it looks like it's 93-ish.
Yeah, so I don't know. It sounds like, all right, the way I take this is inflation's now sort of baked in. People are not comfortable because inflation's not good, but they are like, it's not a surprise anymore. And then your most recent experience probably portrays what you think is going to happen in the future. I don't know. It's just saying people, and by the way, what was this for like 2 decades? It was people's expectation for inflation over the next 5 to 10 years was 0.5 point. And now it's 2%. Like, I don't know what to do with this.
And why do we always talk about inflation, Derek, right? And it's because it has been that data point that has been the driver of the Fed in changing interest rates, right? It's just like I said at this conference, it was I was just amazed that, cheeseburgers, $20 on the strip, I guess. I don't know, right? Just things are more expensive, and it seems like they're going to continue to get more expensive. And it feels like people now are finally going, yeah, I expect inflation. I expect to pay more in prices. I don't think that's inaccurate. And I think this is the thing that definitely could cause the market to stop the upward trend that it has had this year. If there's you always call it, the thing that's going to scare the listeners. It's watch inflation for the thing that is going to scare investors, because if the Fed decides they have to raise rates and change their posture of lowering but not yet, if that was to change, I think the market would react fairly negatively to that.
Did you see that? I don't know if you read this. I think it was on the news. It showed up a couple different places. Is it Harris? They're one of the polling group. Yeah. So Guardian and Harris poll. 56 of respondents said they believe the U.S. is in a recession right now.
Oh,
okay. I don't know who they asked.
I don't know by what definition, though, right? I mean, maybe that might just be some folks it's harder economically, right? Their dollar isn't as strong, but recession?
Do you remember the Jay Leno Man on the Street things? Remember he used to go out in the street and ask people questions, and he'd get
usually questions that everybody should know the answer to.
Yeah, and they'd get them wrong. Like, I don't know. Sometimes with a poll, what is it they're trying to prove and how you ask the questions and things like that. I don't know. But I just thought it was interesting. But I could see, I think because of inflation, like people might equate everything costs more. And in their mind, it's like kind of like a recession because why does stuff cost so much now? Like, would you say a $35 cheeseburger? Like that should be like a tomahawk steak or something.
Yeah. Oh, love a nice tomahawk. All right. Go ahead.
All right. What else? All right. We're done with this then. So we mentioned gold last week, and there was a chart by, this is B of A and Bloomberg. Okay. 2024 year to date. I don't know what the end cap or end data of this is, but so far gold is up 15.1% this year. And we've talked about this prior episodes. It's a very quiet rally. I don't know that a lot of people are talking about gold. The S&P at the time was up 11.7%. And then you have the laggards were investment grade bonds, U.S. Treasuries, and REITs. I think REITs probably, that's a re-rating of the valuation there, or continued re-rating. But I
always love looking at this chart, right? And it's just, you kind of see the different asset classes move and kind of rotate through as the market goes. But you're right. Gold, last year was number 4. The year before that, it was number 3 in the negative year. But look, there have been times it's been the worst performing asset. Gold is always an interesting one. We get this question, should I have gold in my portfolio? Right? We get that all the time. We've talked about a slice of something like gold is not the worst thing in the world. I put it in the alternatives category, right? Yeah. When we do general portfolio investment, we want to have some exposure to alternatives, and gold could be an investment, right? It's one of those things that, we're going to run an option strategy over it, right? We're going to use it to generate income, or we're going to use it in a hedged way, right? Just buying straight, buying GLD, for example. It's probably not something that's going to fit in a lot of our portfolios because it's just, we're always going to be additive with options. But, it's been hard to figure it out because gold wasn't great for so long. And then all of a sudden it's been interesting the last few years. So I think it just goes through these cycles. The real question is the cycle over, right? So when I look at this, back to 2000 historical asset class performance, gold doesn't have a repeat year of being the number 1 asset class, right? But close. 2010, it was number 1. 2011, it was number 2, right? So you kind of get closer. So could it continue? Sure. But so hard to figure what gold is going to do. But generally, it's pretty stable in there. But a couple times it's been the worst performing asset. The one that is always so shockingly stark, Derek, is commodities. And I would say gold kind of fits in there a little bit, but commodities get treated differently in this asset class allocation. And they could be number 1, and then the next year they could be, the very bottom of the barrel.
Then
number 1 the next year, and then the bottom of the barrel. Very volatile performance. They're not, but that's commodities in general can do that.
Just before I move on from this, let me pick a year. Let's say going back to 2018, and this goes to the point of sometimes I think people, it's not that they hate the performance, like maybe they're just always worried. I mean, look, that's why we hedge. We hedge, especially people who have accumulated wealth, those in their prime working years, don't want to give up what they've made in retirement, right? Pre-retirement. But let me give you a couple of returns from the market. Mine is 4.3% in 18, plus 31.5 in 19, plus is that 18 or 16? 16.4 in 2020. It's a little tough to read. 21 plus 28.7, 22 minus 18.1, 23 plus 26.3, and so far year to date plus 11.7. Like, if you knew that was hey, over the next X number of years, that's what you're going to have. You'd be like, yeah, okay.
Yeah, like if you had to pick one of these asset classes and you got the next 20 year of this whole thing, but you can only pick one of these little boxes, And right, if that's it's certainly a compelling argument there, right? You have a lot. That would be interesting to take a look at, Derek. But a lot of stuff moving around. But you're right, pretty consistent with equities.
Look at in the early 2000s too, MSCI EM, like those are massive numbers. That was during that really good growth period for international emerging markets.
Yeah, right. IFA and EM, right? So that's emerging markets and developed international markets did very well during that time period, right? That 03 to 07 range, really strong. Really strong.
I mean, it lost
S&P was still up all those years, by the way.
Oh, yeah. So 2008, it was down 53.2%, and then put in a 79.0%.
If you lose 50% in a year, what do you need to make the next year to make it back up?
You need 3 digits the next year.
You need 100%, right? Yeah. You need to double your money. All right.
Yeah.
That's why I like to take volatility out.
This goes in the category of what people think will happen doesn't always happen. While existing one-family home sales median price, year-over-year percent change, while it dipped down, I'd say, what did it get down? -3% at the worst in 23. Most recent reading is plus 5.61% year-over-year. I mean, look, I'll put my hand up and say, if you told me interest rates would go up this much, I would have thought, yeah, it probably hurts housing. No, because there's not supply out there and people are staying in their mortgages. But no, wait
a minute. Let's be fair. It hurt housing, right?
Oh, of course
I know it's a little positive, but when you look back at 2020, 2021, 2022, right? The year-over-year home sales, they were up 15% at least. One year it's up over 30, right? So they were up a lot more.
Yeah.
You're up 5 this year. Like it's comparatively, it's still on the lower end of all the dot plots of what this would look like.
For people who own a house and don't have to buy a house right now, it hasn't been that much of an impact. You're off the highs, but you're not. I mean, home prices are still going up on a median basis.
Home prices are still going up. Maybe they're going up at a slower rate. I would agree with that completely.
Look, the reason why I brought up this chart is just to make the point. Sometimes you think you know what's going to happen and it doesn't. But so far, I don't know what's going to happen over the next couple of years, but the housing crash that everyone on YouTube called for hasn't happened. They make some pretty compelling arguments on there too.
I'm sure.
Yeah.
I'm sure.
This is also from, I think, Michael. Oh, what is this gentleman's name? McDonough? He's at Bloomberg. All right. If I think of his name, I should give him credit on this one. Bloomberg chart, it looks at monthly mortgage payment on purchasing a median priced existing home. So what's the average house? Use the average 30-year mortgage rate. And no surprise, the cost of your mortgage payment on a median house price is up a lot. And not only your interest, but also your principal, simply because the median home price has gone up, interest rates have gone up. So, I don't know. If you showed me this, I'd be like, there's no way housing can sort of not be down a lot. But no, it's withstood it.
Yeah, I would imagine it's a smaller universe now than, in the other periods, right? That'd be interesting to look at, home sales and the count there. But there will, at some point, people have to move, right? You just have to, right? Or you graduate college and, you're somewhere or, whatever your stage of life you're starting. You're buying a house. It happens. You can't wait around forever to, for rates to go down or whatever it is. But yeah, this dynamic, the amount that, it's costing you to service the mortgage is it's high. It's high compared, to the last 25 years, no doubt.
I wonder, Jay, if we have wealth clients, advisors have wealth clients. Even though their portfolios might not have direct real estate exposure. I mean, they do if they own the S&P because there's stuff in there. But a lot of people own their own home, and it can make up a big percent of their sort of global investment universe. And I was thinking a couple days ago, most people they're not going to trade their house. They're not going to try and time the market. Like when markets were at their peak, yeah, you could have sold your house, but you have to move somewhere else. I guess you could rent and hope for a crash. There were people who might have done that in 2008 or 2007. But I think one of the benefits for people who own their own home and hold it for a long term is it's forced savings, but it also, they're not going to like day trade their house. It's just a thought I had. I think sometimes emotions get in the way for investors and traders trying to pick tops, bottoms, and they don't have to do it as much with housing. It sort of forces you to not do anything, do less.
Yeah, I mean, the only equivalent I would say there is maybe when you're going to decide to refinance, right? That you'll time, right? You'll be like, oh, now's a good time to refinance.
But it's a callable bond. I mean, you can refinance at any time. Sure, you have to double up and triple up.
So I'm just saying, so when I think about the homeowner, what they're timing and where they think they could get a better financial situation, it's maybe that, right? But you're right. You don't day trade your house.
I did know somebody back in, it's like late 2007. He was one of those people when you buy and sell your house, he comes over and he does the evaluation. What do they call it? Appraiser. Home appraiser.
Yes, an appraiser. Yes.
Yeah, and I remember talking to him because I had worked with him at Schwab years ago, and I happened to run into him, and he's like, "You should sell your house and get out and just rent for a while." And I said, "Is that what you're doing?" He said, "Oh yeah, I've already sold my house. I can't believe what I got for it." And he did. I remember running into him, and he rented a place for a while and bought in, I think, 2010 or something like that, where they were giving houses away. Now, imagine you did that in early 2020 thinking, no. Market went up, So I just remember that, though. He totally timed it. All right. Any comments on that?
No.
Congratulations to my friend who did that.
Great job, friend.
Great job. Great job by Japan. 1% yield on the 10-year, their 10-year Japanese bond, similar to the 10-year Treasury. I know I don't get a lot of interest in the Japan conversations, Jay, all the time. But I got to, I collected the charts. I'm putting it in here. And the reason I bring this up, I don't know if it means anything yet. There's some currency things there. There is the idea that Japan's currency has been very weak. And does this mean that, I don't know, if Japan's bond rates move materially higher from here, does that mean there's less interest in treasuries? I don't know. I got to slip it in though, so it's in, Jay. Congratulations.
So let's say I'm an investor in Japan, and I have cash. I could buy a bond and make 1%, or I could take my yen, convert it to dollars, and buy a U.S. Treasury, right?
And you'd still be down because the yen lost. Oh no,
right,
that's right. You actually would have made money because now you're in U.S. dollars. Yeah.
Right, because the yen got weaker, and my holdings, when I go to cash out my U.S. Treasury bond, I get more yen back because the yen is weaker.
Yep.
Right. So there's actually, we know folks that work at Bank of Tokyo, actually, but when I talk to them about the currency movements, it's always a very interesting dynamic how much the government is involved in the stability of their currency and the movement of their currency. And the other thing I would say about this is, this is why the yen gets considered as a safe haven, because when, Japanese investors, have to take their money back out of U.S. stocks, U.S. risk assets, they convert back to their currency, right? Because, they've got that, they might get that nice conversion, right? So it's just interesting to see this. I don't know, the size of the Japanese government bond market, but I don't know. Why would you buy this? I guess it's currency risk, right? You don't want the currency risk, is why you'd buy a 1% bond in Japan over a 5% bond in the U.S.
Yeah. I was going to bring up the Japanese central bank and their holding. I'll save that for another episode when you're not on the podcast, Jay.
Okay.
Let's talk about.
I tried to give you something on this one.
No, I love it.
I tried to give you something.
A little bit of Japan stuff. Okay. Before I want to talk about the VIX, VVIX a little bit, but this was just an interesting chart. Who's this by? Ritholtz. And this is win rate by holding period. So basically they say on any 1 day period in the S&P, this is since 1950, 54% of the time the market would be up. So monthly, about 64% of the time, the market would be up if you held for a month. 1 year, just under 80%. And it looks like at 7 years, 100% of the time, then it goes back to 98%, 98%, 97%. Basically, once you get to sort of 6 years plus, it's almost 100%. And then once 12 years and beyond, it's 100% of the time if you held for that long. And somebody might say, well, what if you're up a penny? Yeah, it counts. You're still up.
You're up.
But maybe this dovetails on what I was saying with housing. It's almost a forced hold. And we don't necessarily buy and hold, we buy and hedge. But I mean, this is sort of an argument sometimes to do less. Less.
Okay, look, so you could make the argument like, well, if the market's going to be up, if I'm going to be up after 7 years, there's 100% of the time historically I would be up any 7-year period. Mm-hmm. You'd be like, why would I bother hedging? And the answer for us is, look, it's always a time horizon conversation of why you want the protection. I don't know when there's going to be an 08. I don't know when there's going to be a pandemic. If you need money in the next few years as you're building, that's when hedging is most appropriate. But long term, it's why we like to use equity markets and indexes, because yes, there's the answer to the test, right? Stay in the market over time, your win rate goes up. The longer you're in, the higher the win rate you have. This is historical data, right? And it's why we encourage people to stay in the market. And yes, when we have to take volatility, use the protection level, use the re-hedging activity as the times where you just don't have to put on a blinder and not pay attention. We re-hedge regularly, Derek. I think we re-hedged last week on one of our hedged equity portfolios, right? Like we moved up the hedges. We locked in gains. Said, great, move it up. Let's create another floor in the portfolio while the market's higher. That's okay. That's if you want to get a little handsy, that's where it starts to make sense. But you're still in the asset class that if you're in for time, it's going to pay. You're going to have a higher win rate, right? So I know, when folks ask me, like, what do I do? Right. The dirty little secret of our business is actually, if you just bought the indexes, you're going to do better than 90% of the fund managers and money managers in this country. You just will. Now, you may have some particular reason why you want to have, like we just talked about, a hedge on because, hey, I'm approaching retirement and I can't afford to have a lost decade, right? Where the market doesn't have any appreciation or just a small amount of appreciation. I need growth, but I can't take the big hit, right? I can't add volatility. If I hold 50%, you got to make 100% back up, right? Then it makes sense. That's where, and then you don't care that you didn't beat the market because what you do care about is you didn't take the market risk, right? So that's always an individual conversation about what you should be doing. I continue to, I don't know about you, but if someone says, hey, I've got $10,000, what should I do with it, right? My general answer is, how old are you? Oh, you're young. You buy the Qs. You're older. Buy the S&P. Come talk to me when that's the one that's, added another zero at the end of it.
There's also the case too, where, take a look at the 2000s. That decade was a lost decade.
Yeah, explain what that was. I just said it, but explain what the lost decade means.
The lost decade meant that the average annualized return over the 10 years, 2000 through the end of 2009, you would have been up. You pretty much would have been flat. Like your average annualized growth rate was like a shade under zero. It's like in between 0 and 1% total return. And through that time, you had 2001, 9/11, you had 2000, 2002, the 3-year bear market, you had 2008, 2009. And I think the impressive thing, or the what I would impress upon people, should I say, 2008 at one point, or 2009, I mean, the market at one point had drawn down, I think it was 50 something percent.
Over 63, I think.
Now, imagine you are someone who is nearing retirement and has, let's say, $2 million. Okay. That means you're down to, maybe under $1 million at the worst of it. And although, it would have come back, that is really tough to take emotionally. But also, the very worst thing that can happen leading up, I call it the acceleration phase, that last 10 years that you're going to be working or in retirement. The worst thing is large drawdowns. So why not be hedged there? Because although the markets tend to be up over time, that's the thing. Imagine you had 2 million and then you go down to you're retiring on the absolute trough in the market, and now you have a little bit under $1 million, 995,000, and now you're going to start drawing money day one. Like, that's not a great scenario. So,
agreed.
Yep. All right, Jay.
You want to talk about VIX? VVIX?
Yeah. So I think VVIX was just interesting in that we look at, as a level, the 80 level is sort of interesting to us. But if you look at VVIX, it really had a one-day spike. It got up to, 84.62 yesterday and has come back down. The previous high on that, the most recent high, was in April, 109.64. I don't know. I mean, to me, it's like this one-day thing where you and I agree, like, did anybody really wake up and be like, oh no, they might not do the cut until November, so I'm going to sell everything I own. Like, really? That doesn't happen. So I feel like that was a one-day blip, and are we back in a low volatility regime?
Well, I don't think we ever really left the low volatility regime, right? And the reason we watch that is it's really an indicator of how much people are speculating on the VIX, right? It's the option prices of the VIX itself. We've all heard of the VIX index. I mean, if you've ever listened to this podcast, you've heard of the VIX index.
But Jay, the VIX spiked to 12.77.
Did you just say spike? I'll give you a spike. It's not a spike. I still think we could hit a 10 handle. We got close, by the way.
Points or percent? Points or percent?
Points or percent?
Well, I'm saying it went from 1186 all the way to 1277.
Oh, I got you. Yeah, who cares? Yeah, so I care what you're saying. Like, the number itself is like, there was still no fear, right? That's what the VIX is telling you. There's no speculation. People still weren't like, wow, I need to spend money to speculate on the market drop. That's usually what happens. Or I'm going to pay for a hedge because I can't sell my stock.
I don't think the VIX didn't really react. I think the VVIX showed that market makers were like, if you want to throw in a hedge right now, it's going to cost you a little more.
It's going to cost. If you're going to use the VIX to hedge, we're going to make you pay for it. And that's what the VVIX told you. And now it's back down. And you know what? We have just looked at the 80 level on that as, hey, when it's below that, things are, fairly sanguine and not too volatile, right? Less volatile than other times. And so it doesn't mean anything can happen whenever. But, this is it. If you're using the VIX and the VVIX as a gauge to say, like, that one-day sell-off that we had on Thursday, is that going to happen again? This information says the likelihood of that is low. Yeah.
Percent in VIX, by the way, is sort of meaningless. Like, we were down, what's the one day? We're down, 6.5% today in the VIX. That's not really meaningful.
Not meaningful. No, it's the level that matters, right? It's
the level.
It's the level you were in. It's almost like, well, no, I don't want to go into the rate of change or the rate of change stuff. Let's just leave that alone.
All right. We could talk about Japan again, or we could just go to recommendations, Jay.
Well, I think both of them are the same thing because my recommendation is sleep. So I'm going to recommend sleep. I need some sleep. I'm going to, after recording this, I'm going to go crash. But no, I thought that was a good lead in with the Japan thing. No, I didn't get it.
No, I got it.
We could talk about it. I may not finish the podcast.
Yeah.
I heard you finish Sugar on Apple.
Yeah.
Little twist at the end, no?
Yeah, and they actually revealed the twist for a second or two earlier on. I don't even want to mention it because
it wasn't all at the very end. You saw it in like the second to last episode, a lot more in the the third to last than the second to last.
That took a turn I was not expecting.
Yeah. All right, so watch it.
I think it was decent.
Yeah, I got good reviews. I think there'll be another season. The way it ended, they will come back. Let's just say there's a manhunt on at the end.
I don't know that you need another season. Sometimes I'm like, I just want to be one and done with these.
All right. That is a little controversy around Shogun because I think they're going to do a second season. There's no more in the book. Like the book's done, right? Like they covered the book in the season that we just watched on Hulu, which I thought was pretty well done. The only bad thing is now we're back to Japan. They did the whole thing in Japanese basically because that's where it takes place. And while I feel it was true, I couldn't do the whole thing where I'm on my phone while I'm watching a show and I could keep track of both. Nope, I had to read the screen the whole time. So that was the only bummer for me.
I'm not a fan of that either, and I get it because I don't like it because then I want to watch the characters, but then you got to glaze down and look at the captions. So I'd rather they do it like I watched the German show Dark on Netflix, which I liked, and they just did the English, voiceovers, and it was really good. Unlike that, what was that one Spanish show where they were robbing the bank and it was awful.
That was awful. It was on Netflix.
Yeah, I hate watched it. So, all right, Jay, I have a sell recommendation though this week.
Let's hear it.
So I watched Planet of the Apes. There's a new movie out. I've never watched. I mean, years ago, the ones from the 70s. I remember seeing some of those. But 2011, they did a reboot of it, and I think there's 3 or 4, including that one, including the most recent one. 2011, I got to put a sell recommendation on it. It was just disjointed. I didn't really feel like it was very good. I'm sorry to whoever made that movie. I promise, I'll like your other movies, but here's the thing. If you're going to watch this one, do you have to watch that one? I don't know yet. I don't know if that, if it means anything. I don't know. But it's a sell recommendation for me. Don't
okay, I won't. I'll skip it.
Yeah. So if you're keeping score at home, that's where we're at. All right.
This 3-day weekend that I have coming up, I will be watching Dark Matter as much as I can.
Yeah. So I will say, I think the show is really good. As a fan of the book and somebody who read the book and knows what's coming, I can't get in. I might have to stop watching it. It's not because it's a bad show. I think people should watch it. It's a really good show. It's hard, though, once you've read the book, if that makes sense. But people should watch it. Like, I'll endorse it. I'll put a buy recommendation on that, Jay.
Okay, good.
All right.
I'll let you know.
All right. We'll let everyone know next week. And that's it, Jay. Time for sleep. See you, everyone.
Sleep. Bye.